Hi, and welcome to Random Rogers Big Picture for the week of February 11th. Two things on the agenda this week. One, an article by Jack Bogle in the Journal, and a follow-up to the subprime mortgage fallout. First, on the Jack Bogle, he had in the Wall Street Journal, he had like an op-ed called Value Strategies that a reader was kind enough to point out to me, and I thought I would go over it. There was also a follow-up interview that he did along with Lee Cranefuss from Barclays, or BGI, I guess more correctly. It's kind of a follow-up to this, and I've got an amusing anecdote to go along with the commentary here. But first, to the article, there were several things noted here that really I don't think made any sense. First of all, exchange-traded funds, for all we know, may turn out to be a blight on society. It may be the downfall of man, for all we know, but it won't be for the reasons that Bogle is talking about in his various speeches or articles or what have you. Most of his, and he actually admitted this in the CNBC interview with Dylan Ratigan, that he's talking more about the marketing, or if you will, or the human behavior that goes with exchange-traded funds and not structural elements of the funds themselves. So from that standpoint, it has nothing to do with ETFs. It's about the frailties of man, which is a completely different topic. But to cite just some things that were in the article that I would disagree with or spin another way, he talks about there's $6.2 trillion total in equity funds. This includes exchange-traded funds, according to the article. Of that 6.2, $1 trillion is indexed. About 400 billion of the trillion that's indexed is in exchange-traded funds, or conversely, 600 billion is in open-ended or traditional index funds. So really, he's talking about expense and taking away from returns and yada, yada, yada. I think his point would be far better served going after the other 5.2 trillion that's in actively managed funds for all of the various reasons that he says. They're more expensive, they are actively managed, which I'm sure he would have a field day picking on, and so forth. So I'm not sure why he doesn't devote more time to actively managed open-ended funds than he does to ETFs, which really are, if you think about it, are really just a different shade of the same color. But be that as it may. He specifically talks about, he goes, can you believe we have an emerging cancer ETF? He's picking on the new health shares thing. I'm almost in agreement with him in that I doubt I'm going to need it. I doubt I'm going to need it for my clients. I doubt the typical person who's trying to manage his own portfolio is going to need the fund, but that doesn't mean it shouldn't exist. Health Shares is trying to do something, innovative, bring something to the market that's not there. It'll either succeed or it'll fail, and that's that. But there's nothing wrong with the choice existing. Invariably, problems will come, and here I'm agreeing with Bogle, problems will come from people using it the wrong way. I'm not entirely sure I've figured out what the right way to use it is just yet. I don't know that it would be more than a 1% weight, maybe a 2% weight in a portfolio, if that. But, again, I have no plans to use them, to be perfectly clear. He talks about also with ETFs, and again, it's kind of a contradiction because he, in fact, is saying it's not a structural thing, but he picks on them a little bit because they average 24 basis points of expense ratio. Well, that's not that much more. I'll tell you, I'm taking his number, his word for it on number 24. I have no idea, but that's not that much more than his Vanguard fund. I think for a long time, Vanguard, I think, was at 18 basis points, and then they went down below 10. Not exactly sure where, but to be competitive with Spider and the IVV from BGI. Not that much different. Whatever the problems are with ETFs, averaging 24 basis points in expense ratios, when you consider that there's, again, using his numbers, 5.2 trillion in actively managed products that have expense, well north of 1%. I imagine the average is probably about 1.5%. I know my firm, we're not going to do this, but my firm was thinking about trying to start a mutual fund, and that was the cost that we were kicking around. So 24 basis points is hardly the end of the world. And if you look at some of the things out there that average 50 or 60 basis points, here I'm thinking of the Wisdom Tree in particular. It's blowing away, no track record to speak of yet, but it's blowing away its competition, which, at that point, does the extra 30 or 40 basis points matter if it does average an extra 3 or 4 percentage points year after year? I don't know if it will average that much or it won't, but if it does, 30 or 40 more basis points, pretty inconsequential. Touching on now the subprime mortgage stocks, I disclosed that I used to own that New Century NEW for one client. He gave me a mandate to buy it. It was just 100 shares, and I tried to warn him. I think the way I said it was the stock will either do great or it'll plummet. I don't know which. And the thing that matters here, and the reason why I'm bringing this up, is no matter what you think about any part of the sector, a company that does mortgages, complex lending instruments, which is really what this is as you start to get into subprime and trying to, get people into a mortgage, if to the extent that that goes on, that is a complicated business. It can be a clean business, but it is a complicated business. Assuming it is clean but complicated, then you have the problem of the street getting something wrong. The street seeing something that looks like it isn't clean, maybe turns out it is, but if the street perceives it as not clean, the stock's going to get crushed. Now this thing with New Century, if that's even the name, I don't know whether it's clean or not. It's not something I was ever going to buy for a client because, all of these mortgage REITs are capable of adding a lot of volatility to the portfolio and going down in nasty fashion. Another one that I mentioned that has had some ugly, ugly days in the last 3 or 4 years is that Novastar, NFI. It's gotten hit pretty hard in the last couple of days, not like NEW, but it's been painful, and this just happens in this subsector. This just goes with the territory of investing here. So if you're looking for something that's going to pay you a 7% yield or whatever it is that they pay, you could probably find the yield without the potential heartache in many other places. That just makes a lot more sense to me than trying to do this. And what'll happen is this little episode, however serious or not that it is, it'll end. I don't know if there'll be casualties or not, but this episode will end. Life will go on, and then at some point in the future there'll be another New Century-like blow-up. This will happen over and over as long as these are public companies. And again, it doesn't have to be about what the company's doing. It can just be a matter of perception. Doesn't matter. This is what you're buying when you buy this type of name. I talk about knowing what you own, the characteristics of what you own. Some things have this type of characteristic, and most things do not. Hopefully that makes sense. Have a good weekend.